Welcome to the Dividend Talk podcast, episode 148. Realty income under $60, a business breakdown, and our thoughts about the stock. Whether you're a seasoned pro or just getting started, Dividend Talk is the place to be for insights, analysis, and unsalted advice on how to make the most of your money through dividends with our own unique European flavor. Oh, and don't forget to subscribe to our podcast and join our community on Facebook at Dividend Talk. See you on the inside. Hey, European DJI. How are you, my friend?
Of course, I'm really energized and excited because this time we're really doing our podcast on Saturday morning because you were on a business trip and you look totally wasted after your jet lag. So, but that's no problem. But actually, I spent this morning already reading a few articles. First, one from Jeremy, who we had on the show last week. He wrote a really nice article about Nextera. If you're interested, guys, look it up on the Facebook page. It's still there somewhere in the top part of the post section. There's a catch there though, that for European investors there might be a certain dividend withholding tax charge that you need to be aware of. Also, our Facebook group members mentioned that on the Facebook page, but nevertheless, it was a really nice written article, so I think it's worth to check it out. We'll put the link, of course, to the Facebook group in the description below. The next one is an article that I read from Life with Dividends. It was really interesting because he made an article about Digital Realty Trust, which he sold, and actually because he feels this is one of his biggest flops. And it was really nice that he spoke about this because we often speak so much about our successes, just generally in the community. And it was really refreshing to read also one time an article from someone having like another look at their business that they own, in this case, Digital Realty Trust, and then giving a breakdown of why his thoughts were wrong and why he sold them. Put also a link here in the description of the podcast. And he was also a former guest of ours, so it's really interesting to see our guests continuing to share knowledge with the community. And I really enjoyed them reading those two articles over a coffee. And then last but not least, why I'm actually really happy, it's May. I mean, I all the time get this message in my head like ka-ching, 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 because these dividends just keep pouring in. I mean, I got my German stocks like last week, like BASF, Bayer, and those are such a fat dividends. So, I mean, this week as well, I believe AbbVie came in, Omega Healthcares came in, and those are all large dividend payers for me. So I'm hoping really to break last year's record of May, and yeah, reinvesting those dividends, baby.
Wow, you've had quite a busy week. There's plenty of articles and plenty of dividends to go around. I started reading Jeremy's one actually on the plane coming home. And I need to finish it off, but it did seem really good. I've been not too close to Facebook this week. I've been away, as I said, in the US, and the data charges are phenomenal. So I can only really use it on Wi-Fi. And by the time I was getting back to my hotel, it was quite late. It was quite an intensive work trip for me, and I'm struggling a little bit. I think I've jet lag fatigue, and I don't know, I feel like I have COVID. I feel the same feeling as I had before. So you're going to have to pull me a little bit through this episode, but I'm really looking forward to it. And your May dividends is quite interesting. June, I think, is my biggest one. Although this month, as you said, we have AbbVie, Danone come in, and some others. So yeah, it's interesting. So I hope you bust this month, but I think June is going to be my biggest month yet.
Yeah, it almost feels like the classical holiday money paycheck in May that I used to get when I was in the Netherlands. So it's a nice one. It's a nice one. But hey, let's get started today. Have you read the news of the week?
Yes. So I know we're going to be talking about British American tobacco. It's been pinging all over the place all over the week.
Yeah, so they really, actually by surprise, announced that Tadeu Morocco will be the new chief executive, replacing Jack Bowles. And it came really as a surprise to us, I think. And also, we could see the share price tank after that, or at least, yeah, I don't. It's always hard to predict if it's one on one, but at the same time, they had, of course, also this litigation issue where they announced 635 million of a fine they have to pay for doing business with North Korea, and I believe the CEO at the time was responsible for that geography. So I don't see in the news report from British American Tobacco that there's a direct link there, because even Jack Bowles, the former CEO, uh, commented himself that it is now the time for a change of leadership to take the business to the next level, which was really like a build up from how well it was going in the last few years. So I think they are not really transparent of what's really happening there. I see it really connected with the fine. Maybe there was even an expectation there in a settlement or something like that. But the CEO is out, so we got a lot of questions also now about British American Tobacco and what our thoughts about it. And I'm just curious, like when you hear this news about a settlement or let's say a fine because of North America, what goes through your head then?
Yeah, I mean, I'll be honest. I haven't read a whole lot other than what we have here, and I was a little bit surprised to hear that the CEO was being stood down or stepping down, and someone new coming in. So it did seem like it's a little bit concerning. There's obviously a reason, a bigger underlying reason for that. You don't just do that for a fine or for doing business. So I was concerned. Um, but I don't, as I said, I don't know the full details behind it. I can't. I have to sit down. I really need to sit down over the weekend and try and catch up. I feel so far behind. I've been a full week without pretty much internet, so I feel lost a little bit. But yeah, for me, it,
So
it is
let
a
me help you
it is
here
a
a
big
bit.
concern.
So the stock is now yielding again at almost 8.4%. Yeah, it's trading at around 2,674 pence right now. It is again touching almost the 5-year bottom low, the stock as well. So naturally, of course, people are really, really curious to what's going, because literally, like earlier at 26 April, it was still 3,000 pence. So it really dropped quite significantly. Let's say 10% over the last, especially over the last 2 weeks. So there's of course quite a drop, and it makes people think like, okay, is this topic still, this company still investable? And for instance, Billy Pitchard, one of our listeners and Facebook members, also had a question about this, like also looking at the balance sheet and such. So people are doing really their homework right now. Now, just generally speaking, I would like to say is that the good thing is that if you look at British American Tobacco, and if we look at kind of the modern way of tobacco consumption, right, of smoking, since 2021, Vuse is the #1 global vaping brand. We also know this whole litigation case in America, right, with Philip Morris, Altria there, also the mistake Altria made with Jules and such. So British American Tobacco has really been the company that has been leading here, I would say, and the most probably even innovative. The reality, though, is that combustibles are generally still, if you look at the entire mix of their sales, it's still by far the largest segment. So where it was around 90% in 2019, it is in 2022 still around 80%. So it is still, the good old tobacco sticks are still most of their sales. The issue is that over the last year, volume mix has been declining quite rapidly in some areas of the world, and price hikes could not really keep up with that. Though revenue overall grew by from 25.6 billion to 27.6 billion. So they have been growing nicely their revenue. But then the profit has been actually slightly declining, because also let's say the costs are higher simply. So this is also important to know. And they had also a high tax bill last year. Nevertheless, they are making almost around 294, let's say 300 pence in earnings per share at the moment. So if you think about that, their dividends are really well covered because the dividends also from the free cash flow are about 50% of payout. So the dividend, in my opinion, is very safe. Now, there was a question from Billy Pitchett also about the goodwill on the balance sheet. So I think if you analyze balance sheets from tobacco companies, you will see that they have a lot of intangibles on the balance sheet. British American Tobacco is no stranger to that because approximately 70% of their balance sheet is made up out of intangibles. And those are really mostly, for instance, the trademarks and patents and these kinds of things. But then also goodwill. In their case, goodwill is 48 billion, which makes up approximately 25% of their balance sheet. Now, this is a lot. This is also a result of the acquisitions they have done in the past. It is not a red flag for me, but generally I would always say if goodwill makes up 25% of the balance sheet, then continue monitoring it because write-offs could happen in that part. And specifically if the traditional how you say it, cigarettes are really getting out of favor, then suddenly all those I say assets on the balance sheet are just not having any more this strength, and then they would need to do major write-offs, and of course then you get really into trouble. But even though I think the company at the moment still spots a safe dividend, they can still hike dividends for years to come under the current if it continues to operate as it is now. But I think we need to keep an eye on this volume of traditional cigarettes and how it's going on in the next 2-3 years. Other than that, if you ask me and you want to invest in tobacco, I can't do it. This agreement I have at home. If you want to invest in tobacco, maybe this is again one of those times that you get it at the 8+% yield.
Yeah, I mean, there is some risks, and you can see that in the share price. Combustibles is the largest market for all these companies. All three is no different as well, and that is declining. There's no getting away from that. We are turning into a more health conscious world. We're talking. That's probably one of the biggest drivers for companies like Danone that we spoke about. So it has the adverse effect on our tobacco companies. It's just a matter of how quickly they can ramp up their non-combustible portfolio. And at the moment, British American Tobacco have been probably the leader in that pack. It's still slower than that. What you would like to see. You would like to see it happen at a faster pace, but they seem to be the leader in that. As you spoke about views there a few moments ago. In terms of the goodwill, I agree with you 100%. It is a small bit of a red flag, but again, you just need to keep an eye on that combustible market. Once a decline is natural over time, and honestly, I think it'll be another 10-15 years before we have even major problems. I don't think it'll fall off a cliff, but it is something to just keep an eye on. But I have no real concerns in this moment. 10 years from now might paint a different picture, but it just depends on how this company grows that non-combustible market for me.
Yeah, and then also to be fair, right, I mainly see teenagers vaping. Yeah, the elderly of our generation is still good old shag and tobacco.
So I don't know about you, but I know people that have transitioned from smoking to vaping, and the theory out there, I don't know if the science backs it up, but the theory out there is that it's a safer option than smoking. So it might be seen as a safe alternative, which is probably why people are transitioning over. So it's
but I don't buy this stuff.
No.
I think people should just not smoke unless they really are aware of the health risks and just enjoy it. So some people get a lower stress level of it, but generally I would always recommend people not to smoke. But yeah, investing in tobacco is of course something else. And I mean, it's really, for me, honestly, if I wouldn't have this limitation at home, I would seriously consider here, because this could be a really nice example of a high yield, low growth stock.
Yeah, and just to circle back, I still need to figure out why the CEO was dismissed. I know he did business with North Korea, but what impact is that going to have on the new CEO and the company going
Yeah.
forward? It's
But generally speaking, also the fine of 635 million,
yeah,
it's really not an issue on their balance sheet. Really not.
the,
So I wouldn't worry about that at all.
yeah, cool. Moving on, we might look at some dividend hikes. I don't think there was too many this week, but there was one from a company that you own, I believe.
Yeah, good old Chubb, the insurance company, headquartered in Switzerland, traditionally an American company, also a Noble 30 member because of its Swiss status at the moment. They raised their dividend by 3.6% to 86 cents quarterly. What is interesting, so 30 years of consecutive dividend growth at the moment. I own it. I bought it $100. It's one of those stock picks that I'm really proud on. I would like to see it hiking its dividend a bit higher, but it has done that a few times over its life cycle, that suddenly it gives a 25 or 30% dividend hike. I don't know when we will get that, but nevertheless, it just keeps chugging along and makes me happy, I would say.
Nice, nice. It was a nice pick. I remember you writing an article about them at the time that you bought them, but they've seemed to done quite well since you bought them. So fair play. I don't have any more. I think that was the only company.
Yeah, there are a few,
I've
but not
I've
worth
known.
mentioning. Not worth mentioning.
Okay, so we'll talk about Realty Income, a company that's on everyone's lips, the monthly dividend paying company. But why now? Why is my timeline clogged with Realty Income this week?
I think it's really simple. The stock is one of those stocks that is considered as a really safe stock, the monthly dividend payer, and it really hit the $60 price range. So literally 60, where it hasn't been really trading for the last 2 years, except for a small dip at the end of last year when it reached 57 euro, $57 or something like that. But it was for a really short time period. At the same time, it's a stock that's yielding 5%. So also from a yield point of view, it's one of those few attractive yielders at the moment, because the basket that you're otherwise looking into is 3M and these kind of companies, but they all have a broken story to it. So I think this is really the reason why everyone is looking at this, or why many people are looking at this. And also, of course, myself, I'm not a stranger to psychology and such. So I also get affected by this when I see this all over my timeline. But I think it's therefore also good to do a bit of a business breakdown today, share a little bit how to look at a company like Realty Income, and eventually also share our thoughts about it, right? And I'm also
Yeah.
very curious to hear whether you're considering to buy more. So yeah, that's I think the reason why we're talking about it at the moment.
Yeah, I think it's always good to talk about these companies, because I feel Realty Income is similar to Johnson & Johnson in that everybody out there says the same things. It's a quality managed company, yada, 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 and consistent. But do people actually really dig down into the company enough? Or are they just following along what the general rhetoric is out in general public? So it's interesting to go through it. But there is a couple of reasons that Realty Income is a special company. Obviously, the first one is that it pays a monthly dividend, and not only that, it's been consistent for over 640 quarters, but it has raised it consecutively for 102 quarters. I mean, that is quite something. But the only issue with that is I don't think it can go along with that forever. There's a point when they will not be able to raise that dividend in a quarter. How will that affect investors psychologically? It's going to be an interesting question. Also, they are a triple net lease company. You hear that thrown around all over the place, but what does that actually mean?
Yeah, so a triple net lease is really a kind of a lease agreement with your tenant for property, whereby the tenant, so the one who really pays the rents, promises actually to pay all the expenses of the property, including the real estate taxes, the building insurance, and the maintenance. So, and this is even in addition to the cost of the rent and the utilities itself. So triple rents from that point of view provide typically a really low risk compared to other lease agreements. And this is why I think Realty Income focusing on triple net lease is so interesting, right? Because effectively you need to make sure there's a building and the rest is actually being looked after by your tenant, right? And then we're not even talking about the rent escalators that you want to put in those contracts as well, so that depending on your agreements, whether it's like inflation adjusted or whatever it is, that you can also continue to hike your rents in whatever economic situation we're talking about, at least from a contractual point of view. So generally, triple net lease properties are very popular because they provide, generally speaking, a low risk and steady income to a company like Realty Income.
Yeah, yeah. And I mean, they don't have to waste cash flow on something they're not going to see a return on either. They don't have to pay out, so frees up cash, allows them to reinvest that into the business. So it is one of the nice things about Realty Income. They are other companies as well, Triple N as well, which is one of their competitors, is Triple Lease. But it's definitely a nice to have when you think about a large scale real estate investment trust like Realty Income. Also, if you look at their tenants, I mean, that's probably something, when you think of Realty Income, you think of high quality tenants, don't you?
Yes, and this is also really, really interesting. And when we talk about high quality, I think they often talk about A-grade tenants. What is good to know is that a few years ago, they had like 50% of their portfolio, I believe, in A-grade tenants. That has declined a little bit to 40%, and we'll get back to that later. But think about the tenants that are in there from American point of view: Dollar General, Walgreens, 7-Eleven, CVS, Walmart, Tesco, Lowe's, Kroger, Sainsbury's, FedEx. I mean, we know all these kinds of companies, and we know that these companies are really well-run businesses. They go through their cycles, but none of these companies is at the risk of bankruptcy anytime soon. Maybe Walgreens or something like that is transitioning here as well, or having a bit of struggles, but they don't have issues with paying rents. So having Realty Income with such kind of tenants in there, and if you look at that, right, and the diversification in that, it looks really good because, for instance, the larger tenant is Dollar General, and it's only 4%, only 4% of the entire portfolio. So what are we talking about here, right? And then if you look at the industries that they operate in, and you would look at the diversification there, grocery stores make up 10% of their client base, tenants. Convenience stores, 8%, drugstores, 6%, restaurants, 6%, for quick service. So it's really like well diversified across industries. And we saw that, of course, also during COVID, as an example.
Yeah, and I mean, one of the benefits of having such high profile names as your tenants, take Walgreens, you spoke of them as been a turnaround, which we've spoke about on the show before. If they miss a rent payment, for example, they can't hide that fact, because Realty Income will highlight that, and it will 100% affect that company stock performance during that time, because there'll be worries about, okay, they can't afford the rent and other worries like that. So you can see by the quality of names that they have there that it is relatively safe. And I believe on their latest investor relations presentation, they said that 91% of their portfolio is resilient to economic downturns. And I think that's important too. They're not in discretionary niches that are at risk to closing down because of the internet or any other of these reasons. They are in resilient businesses that are strong and that should be able to withstand economic downturns. So there's been talks of recession. I think that's kind of cooling off a little bit. But I think they have a really, really safe portfolio. And it was interesting, you mentioned some companies there. I don't know, Tesco, Sainsbury's and B&Q. I'm not too sure about the west part of Europe, but certainly in the UK and Ireland, these are strong leading brands. Tesco, Sainsbury's and B&Q would be one of the top 3 brands actually everybody would recognize. And it's interesting to see that they are diversifying away from the US and now more into Europe as well, and it's not insignificant. I think they have a 7.2 billion European portfolio on their books now as well.
Yeah, and this is also really interesting, right? So if you buy Realty Income, you also buy a piece of Europe with this. As an example, did you know that from the, let's say, from all the states that they are operating in, right? They have a nice breakdown. And if you then also take the European countries with it, Texas is contributing the most to the contractual rent of 10.3%. But then the second biggest region is the UK, actually also with 10.3%. So it's not just a pure US play. It is also a part of that European play. And actually, this is also where they expect most of their growth coming from. So over the next few years, they really want to expand in Europe. I find it, I'm not sure actually if this falls into the category of diversification or diversification, because we know how difficult the European, how is it, real estate market is. We also know how every country has its own tax policies. So I believe that for a company like Realty Income, I can't imagine it doesn't come with increased overhead. You need suddenly all these kinds of specialists that understand the local market, that understand tax legislations, and whether those will be whether that will be internal overhead or they will be depending a lot on consulting firms. I don't know, but I can't imagine they will get the same kind of margin out of that coming into Europe. And Europe is also a very competitive space from that point of view.
Well, I have to say is that they picked a very specific part of Europe, which is the UK market. And if you've been following the UK market ever since Brexit, we've had kind of disaster after disaster, which has pretty much hammered that real estate market over there. So there's been plenty of opportunities, and I think they've got in at a really, really good time. I think it's very clever at the timing that they've got into the UK market. And I'm sure a company of that scale will have the framework in place. They will have people on the ground, as you say, consultancy firms or so on. But I'm impressed that it's mainly UK. I know they have a little bit in Spain, but I think they took advantage of the UK in the right time. And looking at the quality of the companies that they have there, you're looking at Tesco, B&Q, Sainsbury's as another one. They are really, really strong brands over in the UK and also here in Ireland. And I think it's true business. I'd be worried if there were more in, say, the German
or Sweden
because but it is a lot more complex, a lot more harder. But I think they've took advantage of the UK at a really good time.
So all in all, I mean, I think it's fair to say that we see it as a high quality business. It doesn't come without risk, but just to mention, if you look back at Realty Income's performance on a total return base from the early 2000s and compare it with the SPDR S&P 500 ETF Trust, ticker symbol SPY, then SPY had a total return of 1,560%. And Realty Income 5,480%, which is of course really, really a large gaps. And I think it's a testimony to the quality of what Realty Income has been able to perform. But it comes also with an issue because, for instance, it's now so big, that it needs to add so much real estate every year. Like I think this year it's against 6 billion or maybe even 9 billion. But can you still find so much high quality real estate, and can you find so many high quality tenants? So I really see Realty Income already being at the stage where it will be really hard to expand. Like Berkshire Hathaway has a little bit as well. At a certain moment, you are a whale in the industry, and adding a few properties here and there is not being incremental anymore to their business. So the question to you here is like, doesn't this just trigger being less greedy to the properties you're buying and therefore starting to introduce, for instance, lower expectations to your tenants, maybe worst contracts, maybe worst deals where you get a less return on it?
Yeah, I mean, it is a major concern, and I touched on it earlier with the consecutive dividend increases. I mean, there's only so much these guys can grow. There is a cutoff. There is a cutoff point. You can't buy quality all the time, or you can't have quality tenants all the time. So it is a good thing, as I said, we're moving into Europe. It's a vast world out there, but as you said, their
Yeah.
expertise may not be the same there. So I would worry about that. And I think from a capital appreciation point of view, I think we might see that taper off. I don't see much in terms of that. So that makes dividends important, which makes valuation, dividend yield, and dividend growth
Yeah.
important as well. And we're going to touch on that later on as well.
Yeah, yeah, that's good that you mentioned that, because also, for instance, in the latest annual report, I believe the CEO even mentioned that they are guiding on an adjusted funds from operations of $4 per share, and we'll touch soon also about what that means. But that's only a 1.7% annual growth at the midpoint. And if you look at that, there are, of course, other companies out there like VG Properties that we discussed the other day. They are like aiming for a 10% growth.
Yeah.
So if we look at that, there's just not a lot of growth expectation from management itself when it comes to Realty Income. So maybe that's then also the nice topic to start shifting into, how to value a company. But for that, I think there are first a few items we need to discuss about how do you actually analyze a company like Realty Income. And also Kali had a comment here. He says, like, how come many real estate investment trusts have a payout ratio of more than 100% and are still considered a good buy? Like Realty Income is like 200%. So maybe you can clarify a little bit on that.
Yeah, I think that the misconception, or a lot of people are used to looking at data in terms of earnings per share. When you look at the payout ratio, it's always connected to the earnings, but that is not how we should be looking at real estate investment trusts. Basically, they can do large kind of depreciations, which can affect their earnings. They are susceptible to more one-time big events that they have to pay off, and that really has an impact on earnings. So I think it's always key to look at funds from operations. That's the key metric here. And if you actually look at that for a company like Realty Income, it is in around, I think it's 80 to 90%, which is typically what you'd see for a REIT.
Yeah, nice one. And then, so one is funds from operation, and it's probably then also good to mention that another thing that is really key to the industry is what they call the cap rate, or the capitalization rate. This information is not easy to find, because it's not like you look at Realty Income and you think like, what's their cap rate? No, the cap rate is more about at what kind of costs, let's say, of what kind of return on investment they are buying properties. Yeah, so really, when you think about it as something like the return on invested capital. This is something similar. So if you're a manager in Realty Income and you want to buy a property, you are trying to look at the cap rate. And how do you compute it? So you can really look at the net income which the property is expected to generate, and then dividing it by the net operating income and the asset value. So that's how you get a cap rate. Now, if you go to the annual report, Realty Income is, and that's what I like about this company, it's always really transparent in their numbers. So, for instance, in their latest acquisition, where they were buying approximately 900 million additional properties, they are expecting to close that at a 7.1% cash cap during the first half of 2023. And this is a bit higher than they used to do, but this is good because the interest rates also went up. So what it's telling me is that they were able to buy properties a little bit cheaper than they used to do, and this is of course also, again, that you have lower. Let's say you want to pay less for the same property if you know that you need to pay more interest, right? So the cap rate therefore gets also higher. And for a company like Realty Income, the difference between the interest rates they pay on their debt or by issuing shares, and I think issuing shares at the moment is what is it? You pay a 5% yield now, So if you have a cap rate of 7.1%, and I'm really doing this in simple language, there's a bit more complexity behind it, but you make kind of a 2.1% in that case, let's say. So this cap rate is quite important to check if companies like real estate investment trusts are really transparent about this, because this is for me one of those things where you really see if the deals make sense or not. Yeah. And we had our German friend here from Defama on the show as well. And what was it? He's looking at double-digit
Yeah.
kind of cap rates, right? Otherwise, it's not investable for him.
Yeah.
He has the advantage that he's still so small cap that it's probably easier for him. 2-3 properties additional at such a rate is of course meaningful, but not for Realty Income anymore.
Yeah, and I'm glad you mentioned actually their access to capital is slightly lower than what it was. I think with real estate investment trusts, credit ratings are important, and because that also attributes, doesn't it, to what they can borrow and at what price they can borrow. And for real estate investment trusts, borrowing money as cheaply as possible is more probably important than it would be for a company like 3M or an Intel, because
and Realty Income typically issues shares, right? And Pavel Jurasek also had a question there. And actually, like, what kind of financing do you prefer for a real estate investment trust? Issuing debt or issuing shares?
For me, it's probably issuing shares. I know it dilutes the company a little bit, but I prefer them to issue shares than use the debt method.
It's also easier to measure for us as retail investors, because if we see the dividend growing and we see the dividend payout ratios based on funds from operations staying similar, we know that the issuing of shares has been accretive straight away to us.
Then the last, one of the other important things is occupancy rate, isn't it? Occupancy rate and rent collections are probably the last two things I would look at in terms of when I'm valuing a company. Companies like Realty Income, as we mentioned, they are high kind of quality tenants that they have. So you would expect them to have a really, really high occupancy rate. And you can see that in their trend. I think they're sitting at around 99% at the moment. It dipped slightly back in 2020 down as far as 97.9 when we had COVID hit, but that was still a really strong number when you consider the median average of the sector is 94. And that's without COVID. So even when we had a COVID hit, they were still well above the average.
Yeah. So this really shows that it's a high quality business. But then the question, of course, is also, is the high quality stock? Yeah. And this is where we really go into the numbers. We know already there's, I said, quite a dilution going on as a stock. But the other end, what is really nice, if we look at the adjusted funds from operations, and you can find the definition of that in the annual report of Realty Income, why they are adjusting a little bit. From my point of view, no red flags there. It seems to make sense. It has been just growing over the last decade. So that looks really good. And I expect it also, albeit slowly, still to grow, and towards this year about $4 per share. What is interesting is that the dividend per share at the moment is 3.06, and they pay it out, of course, distributed over 12 months. So it has really a nice dividend payout ratio of around 80%. And actually, if you look over the last decade, I think 10 years ago, the dividend payout was rather towards the 90% and now towards the 80%. So it has been nicely declining over time. And I like this trend, but I believe also real estate investment trusts are obliged to pay out approximately 80% of their funds from operations. And they are doing that nicely. Now, where the issue is for me with this company, when we look at valuation, is the slow growth anticipation compared to the current adjusted funds from operations. So they bought V-Ride last year. This means that they got a lot of additional funds from operations incoming, but of course also many shares issued at the same time. But at the moment, in the last year, they made about 2.4 billion in adjusted funds from operations. So let's use that as a baseline soon, also when we calculate our fair value. But maybe also what's good to know is like the 5-year dividend growth was 3.7%. If we look at the current dividend yield, it is 5.1%. So it gives us the Chowder rule of 8.8%. This is not a lot. This is actually relatively low also for a real estate investment trust. We would like to see that more. If we look at the multiple, so price to adjusted funds from operations, we're talking here about almost a 16 PE. Honestly, I find that high for companies in the real estate investment sector at the moment, knowing the interest rate environment and the risk associated to it where we are. But it probably speaks for it to be a high quality company to have such a multiple. Debt to equity is about 65%, but I don't think we should look at this number here really. So having said that, if we look to take the adjusted funds from operations of 2.4 billion, let's take a growth number of 4% over the next 5 years and 2% thereafter. Remember, this is 4% is actually double the amount that the CEO is predicting for this year with 1.7% growth. Yeah, but let's look over a 5-year period. And we give the discount rate of 12.5% because that's the return I want to see for a company like Realty Income. I also give the terminal multiple of 13, which is lower than what it is today, 15. I still think it's a high quality company, but I believe it should be a little bit less in the multiple. Then I only get a fair value per share of about $44, which is far off from the $60 right now. If I'm a little bit more bullish and I take a 5% growth rate for the next 5 years, and again, I repeat, this is much more than the current CEO is anticipating, and I take then a growth rate of 3% thereafter, a discount rate of 12.5%, and a multiple of 15, we are talking about $50 per share. That's still $10 less than what it's trading for right now. So all in all, if I take all my baseline optimistic and bearish case together, with my discount rate and my return expectation of 12.5%, I believe the company should be valued actually around $45, which makes this company still heavily overvalued from where it's trading today.
Yeah, and I think that's always one of the key concerns that you hear about Realty Income. They do seem well managed. They have an unbelievable track record, but at some point that growth runs out, and we're looking at valuation. How much can they grow in terms of share price? I don't know. Not a whole lot based on those growth numbers. So you're really relying on your dividend growth and your dividend yields. So they become a little bit more important to me. And then you have companies like you mentioned, EDGI, who have a high starting yield, but also have growth. Now, they don't have the track record and they don't have the management. So it is a bit more of a risk. But in terms of returns, you have to risk a little bit more to get the greater returns. So the question is based on those valuations, everything that we've said. We've talked about the management, the history, how you value that company. Are you buying them?
So actually, yes, I bought yesterday 10 shares, just a few. Why? I'm just buying it as a 5% yielder with a really safe dividend payout. However, I'm not doubling down. I'm not aggressive on it. I think I will become aggressive when it starts hitting the $50. So now for me, you could rather see it as kind of a little bit of a reinvestment of the dividends here, just at a yield that is attractive enough for me, but I don't have high growth expectations there. For that, I want to see a cheaper price. Also, the yield will be much better there because I expect just slow growth. Yeah, I don't expect that we will see the same growth as we have seen over the last 2 decades in Realty Income going forward. I truly believe if growth needs to come from the European market, that this will be much tougher environment, much different competition as well compared to how the US market looks like and the relationships they have there.
Yeah, I'm in the same boat. It's more of a reinvestment play for me rather than buying them. I would much rather see them under 50. We spoke about AT&T under 30. It'll be Realty Income under 50. But I think if I wasn't invested, if I didn't have money in Realty Income, it would be a company that I would like to own. As you said, it has a really good history, but the dividend is safe. The management is really good, and I think it would be a good company to hold. But in terms of a total return or in terms of trying to grow your portfolio more quickly, there are other alternatives. But starting out, I would like to have them as a foundational stock, and when they drop below fair value, really eat into them. But at the moment, I have them, and I'll be just reinvesting the dividends.
Yeah,
probably I don't even know if I have enough to pick up a share every time, so I'll have to add money to it. But it'll be just picking up a share or two here and there until they drop under that $50 mark.
Yeah, and then this is maybe also already a nice bridge to the listeners' questions that we will start soon with, because Martijn Hoek is actually asking us, like, why are we even making fair value calculations if you just want to hold a stock for 20 years? Does it even matter whether we pay $60 now or $50 now? You know, if you expect the dividend to be able to grow over the next 2 decades, so why are we doing even this, Derek?
Yeah, sometimes I don't look 20 years out. It's more 10. It's really hard to predict 20 years. I want to buy them and hold them forever. That is the dream.
Yeah.
And you would love to be able to do that. And in which case, valuation probably would not matter. Inflation would take care of the share price eventually. But 20 years is a long time. And we can see even within our own portfolios, 5 years, a lot can happen. A lot can happen in companies. It'll change. And you do want to be making sure you're getting the best return from your money, whether that's from capital appreciation or from dividends. We're dividends, so we want dividends and dividend growth. So fundamentals can change a lot in 20 years. So I tend to look 5 to 10 year period. And I think that's why valuation is more important for me.
And then valuations also often go in correlation or in conjunction with yields, because if the valuation is really high, like Microsoft or Apple, let's say, the yields are really low. So they're usually not even interested. So actually, I think there's a lot to say from just saying, like, okay, if I can just buy companies, let's say, that are yielding 3% and the dividend is below 70% payout or 60% payout, you can even put your ranges there.
Yeah.
Then, and I believe that the company will do better 10 years from now than where it is today, and management is good. Just buy it. You don't need to do a whole fair value calculation potentially if you want to keep it simple. Myself, I really do the business analysis. I look at the screening criteria, but then also for me, the valuation is more to say, like, you know, I want to know whether I should be aggressive in this company or not. And often by doing a calculation as well, you actually see, and this is what I love about it. For instance, now many people are buying Realty Income at $60. But because of doing this business breakdown that we're doing now, looking also at the risks of the company, looking at actually what the growth expectations are, we know that there's a high likelihood that we might get this stock at a much better price later on. This may be timing the market. I realize that, but it's also about where do I invest my money now to have the best dividend growth prospects, because it's not just about yield here, it's yield plus growth. We're dividend growth investors, and that's where evaluating a company really helps me in this one, because if the stock seems heavily overvalued, usually my experience is don't expect too much dividend growth in the long run also behind it.
Exactly. And I mean, if you get these under 50, you're probably looking at what, maybe 6-7% yield. Add that to now your 3% growth rate. Now you have a different scenario than your 8% that we're getting at the moment. And as we said, at the moment, it feels a little bit like a candy store out there. We can get high yielding companies, some good European companies as well, with decent growth. So I think it does become important. You don't have to do a dividend or a discounted cash flow. You don't have to make it that complex. The dividend yield that you mentioned is probably perfectly fine for most people, but I think it is important to have some sort of yardstick that you know when you want to buy or not a company.
Awesome. So, hey guys, if you like these kinds of business breakdowns about a company that's currently, for instance, in the news or having a lot of attractions, let us know from time to time, but also let us know as a review to this show. Was something more new for us to do, but I enjoyed a lot doing it because it also made my thoughts clear again about the company. But let's go now to the listeners' questions, because we have a bunch of them. We have split them a little bit. First, a bit more educational related questions, and then probably a little bit more about our thoughts about some of the tickers that you shared with us. But let's try to go also relatively quick through this.
Yeah, we will. And Jeremy, who was with us last week, asked us our first question, and he asked, do you have any insights on preferred stocks? Do European companies even offer them? And would you ever invest in them?
So let's start with the last questions. No, I don't invest in them, because usually they come with higher yields, the preferred stocks. They should give us a little bit more of safety when it comes to dividend payments. But honestly, if you see what's happening lately and how much there's respect for the shareholder, I don't find them interesting at all. Usually there's really nothing there, no capital appreciation either. So no, I'm not a fan of this. Whether some European companies offer them, I believe so. I've just not looked into this for the last 5-6 years. So not my part of investment style.
Okay. Simon Stott has asked us, does size matter? Most dividend growth companies discussed on podcast, even ours, are probably large cap companies. So the question is, do we have criteria on a company? He's thinking about someone like Chesnara, for example, which has a 400 million market cap.
Yeah, or even just Defama, which I believe is around 100 million. So yeah, I don't mind buying them. However, I do consider oftentimes the risk profile a little bit bigger, not because of the company being having a higher risk profile, but me having less access to information, publicly available information. So that's why it's a bit harder for me to invest in those companies. And there, for me, also the Peter Lynch kind of topic comes to the forefront. When it's small cap, I really want to have a feeling for such a business and the CEO, even more than for a large cap, because then you really want to see let's say you want to physically see their business flourishing, right? And with Defama and their assets, I can step into a car and on the road to my family, I can just visit their assets and see them in real. Yeah, and that's so much different. So that's more of a criteria for me. Of course, this doesn't really apply to Chesnara, but I know that Chesnara I know what kind of companies they are buying in the Netherlands. I know those kind of companies also from pension funds. So I kind of have a good feeling with that. So that's my main criteria when it comes to small cap companies.
Yeah. There's probably more money to be made with small cap if you know your way around and you know the markets fairly well. You have to remember, we're retail investors as well. We probably don't have that professional knowledge of small cap, the really gritty numbers. I mean, we all have the high level. I think large cap companies, there's a lot more information out there on all large cap. You can open up Seek and Alpha, for example. You can find any amount of information that you want. Looking at small cap companies is a little bit more difficult. Even navigating through their IR, their investor relations part of the website, is not always as clear as some of the large cap. And I give you an example of Miller Industries. I don't know if you ever heard of them. They're into like towing and all this, but they are a really, really good low cap company. I think 398 million is their market cap, but they have a really strong dividend track record, not necessarily dividend growth, but in terms of paying consistent dividends. But just look through their investor relations. I follow them for sure dividend. I have to write about them, and sometimes it's really hard to find the information that I need compared to someone like Intel, Microsoft, and all the large caps. So it can be a little bit harder for retail investors, and I think that is why we stick to the large cap companies. But small cap, there's definitely money. There's some really good companies there as well. So if you can find a gem, hold on to it, I would say.
Nice one.
Prabhu has asked us, when you invest every month, what happens when you don't find a good bargain for your dividend or growth portfolio?
Usually, I then buy more shares of a company that I own already, that I already analyzed, and where the yield is attractive enough. But I need to invest my cash every month, because that's what dollar cost averaging means for me. And so I'm not waiting, I'm not putting it on my savings account, I'm really investing it that month. And sometimes it happens that on the last day before I get my new salary in, I quickly buy some shares and just in the company that I own already.
Yeah, I think dividend diplomats talk about foundational stocks, and I see a lot of investors talk about the core holdings. And I think if you don't find a bargain, it's always good to add to your core holdings. That's probably a safe bet. This question is going to be fun. So Manny Mystery has asked us, Do you think the LGBTQ plus stance of companies like Bud Light, Disney, and now Target is an investment risk that should be taken into account?
Oh boy. It's good that I'm not, how you say it, after a vodka shot. I get for to not say any things I will later regret. But honestly, I don't take this into account here. Maybe it should be, but we start talking quickly about woke again. And I have an issue generally with companies that are on the extreme woke side of things, because I feel like they are really shifting away from typically from being having the shareholder interest first. And as a shareholder, I would like to see that. And I also sometimes wonder, like, if you have so much time to think about that, then are you still putting enough time in the core of your business? And I don't see this as the core of the business, because you know how bad it sounds, and I'm not talking about LGBT in general. It's still a minority of the population, still minority of the customer base, and I think companies need to really provide equal access to products and everything. But you know, this time it's LGBTQ, and I know it's also really polarized in society at the moment by politicians. But can we maybe talk a little bit more about poverty and providing access to many people and that are at the bottom of society at the moment because of what's happening now with inflation? Yeah, so I have a bit of an issue generally why LGBTQ is all the time emphasized compared to other issues that we have in society. And I wish we could go back to the 90s, which I found a really great time of tolerance in the Netherlands when I was at school and everything. And there were enough people that we knew of that were homosexual or gay. There was no issue with it, at least not in my mind. But now everything is under an hourglass. It annoys me. I'm not saying that there is no issue, because the sad fact is that I have a feeling that society is not so tolerant anymore compared to 20, 30 years ago, at least in the areas where I grew up, compared to these kinds of topics. And it's a shame. It's really a shame. But from a company point of view, I think there's something toxic going on in some of these kinds of companies. It doesn't reflect society anymore. And I think we should go back to what companies exist for, and that is growing shareholder wealth and helping a little bit to do better for society at the same time.
I mean, in terms of an investment risk, I don't think it is a huge investment risk. I think these companies are trying to jump on, I don't like to say the word, but more of a trend, because we do know this is more trending at the moment. So they're trying to jump on that. But someone like Bud Light, for example, all they did there was alienate their actual customer base, rather than what they were trying
that's
to
exactly
achieve.
my point. That's exactly my point. And for instance, if we enjoy this, then sponsor the Eurovision Song Festival or something like that,
Yeah.
right? I watched it on Saturday again. I mean, I love the show every year.
Yeah, me
I
too.
didn't like the winner. I would have Finland to win. Sorry to my Swedish listeners here, but Cha 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 was much better, and the one from Norway,
Yes, that was my
Queen of the
favorite.
Kings,
Yeah.
mine as well, really great. And then even Poland with Solo and Blanca
Yeah.
and Baiba. Yeah, sponsor those kinds of events. Yeah, we know there's a lot of LGBTQ presence in these communities there, but all this stuff with this other one of being overly woke, please stop it. Just go back to the core of the business.
Yeah, I mean, look, fundamentally, every business should know their target market, who they're targeting, and why. There's probably going to be specific companies that target LGBTQ markets, and yes, their ads, they should be solely
Exactly.
focused on that. So it's just know your market. But honestly, I think these big companies are just trying to jump on what's on social media and try. Yeah, they're probably trying to include more people and trying to get a new niche. But you still have to look after your core markets as well. So inclusion for all is what I would say, not just target single
Exactly.
thing. So yeah, but I don't see an investment risk in them. I think companies are just trying to adapt to times, and we are living in times where social media has a huge involvement, huge presence, and it can certain trends can take off quite quickly and it can die off quite quickly as well. So companies have to keep up with that, which is not easy. But for me, investment risk, no.
Good.
So next question is, can you pronounce that name?
Uitdelingscontroleren.
Yeah, I know you do it better than me. So he's asked, have you guys had totally different views on certain dividend stocks?
Yeah. In my opinion, one that came straight to my mind was Walgreens. Because I know you were really looking into them, and I felt like pharmacy business, real estate. Yeah, but I know you invested quite a lot of it. But is there one that comes to your mind?
Yeah, I know there's been a few, but I can't really remember on the spot. Walgreens was one, but there is one quite recently in our portfolios. But we do have different views on certain stocks. And I invest in
Intel maybe
Intel.
About the time and when to buy and when to hold it. Maybe
we have shifted on Intel. I think I was more bullish, and then I came out of it, and then you transversed into more bullish, and we flip flopped on Intel. I do invest in other high yielders and CEFs as well, which I know you don't. So we do have a little bit different styles, but yeah, we can have different views on dividend stocks, but that's the beauty of being an investor, isn't it? Nobody's going to have the same outlook on the same companies.
Yeah, but what is also happening here is, like, I really respect your opinion. So if I start talking about a stock and you call out the bad things, I do my research again, and usually you're right. Yeah, so we tend to probably gravitate towards each other because we keep each other in check.
Yeah, and you see that in the wider community as well. I mean, we have Facebook and Twitter, and stuff goes into there that I might overlook, you might overlook, and it gives me a sense of reality, because sometimes you can have bias, and I know I'll be quite biased, but when you see or hear someone else, particularly that spends a lot of time and is passionate about it, then it makes you sit up and notice. But I think having different views on certain dividend stocks is quite healthy, because if we agreed on everything, we would never grow. We would never learn anything other than what we already think we know. So, Robert has asked an interesting question. He said, as I know, in Europe, you cannot buy American ETFs, but he just bought last week SCHD. Is he missing something? He is from Croatia and trading with UniCredit Bank or a Saxo broker platform.
Yeah, I don't know. I don't know, Robert, your circumstances. For instance, if you're a professional investor on interactive brokers, you can buy SCHD. Maybe there are some specific regulations in Croatia that allows you to buy this, but I can't buy it. And I know people will tell me, well, EDGI, you can sell a put option, and then when it gets exercised, you get the shares of the ETF. For me, these are kind of workarounds that I don't participate in. So generally speaking, not. There might be some exceptions there, of course, in Europe. We also know some brokers that are more American-based, having clients in Europe where you can do it as well. Yeah, so generally speaking, not, but there are some workarounds at times to this.
Yeah, there possibly is workarounds, but the issue I have with workarounds is you don't know the risks of that, or what can happen as a result of that. And that's the biggest thing. We all talk about safety. I think we spoke on the show about safety of our brokers, IBRK and the Hero. And now you're talking about workarounds in other brokers or in American brokers where their rights don't really translate over to Europeans. So what happens if they go bust? What happens to your money? What happens to your shares? There's lots of things to consider. I'm sure I could find a way to do it, but I can't find a way safely to do it under the current rules of the European Union. So I don't tend to do it. And remember that loophole when interactive brokers, was it recently, and people were able to buy, was it partial shares? I can't remember what it was, and I stayed away from it because I felt it'll come back to bite us, and that's what happened. So for me, safety is important as well. I'm only investing money I can afford to lose, but I don't want to lose that money, and I don't want to risk more. I don't want to take more risk than what I already am. So
yeah, good one.
Okay, so Calise has asked us, what do you think about Altria's 8.5% dividend?
I don't like it as much as British American's tobacco's dividend. They are almost yielding the same at the moment. And if I look at Altria and how it's been managing its business over the last years, the litigation or the patent issue that it had with British American Tobacco, the Juul acquisition, their debt profile as well, then for me on this, British American Tobacco provides a much better it's just a much better stock. Probably business wise, I would even say British American Tobacco is slightly in my favor, but stock wise, I like British American Tobacco much more than Altria.
Yeah, I mean, look, if you look at a dividend yield and dividend growth perspective, Altria is probably coming out on top a little bit. But then you got to look, you mentioned earlier, British American Tobacco was 50%, if I remember, free cash flow
Payout,
ratio. You're looking at Altria, and this is from memory, but I think their dividends around 6.5, 6.6 billion, and their free cash flow is around 7.9. So it's a little bit higher, it's around 70%. So from a free cash flow perspective, British American Tobacco comes out on top. And as we said, this non-combustible market is starting to become more and more important because of the combustible market's decline. And again, British American Tobacco. But I do own Altria. I don't own them at that high. I think it's around 7% dividend yield. But the question is, what do you think about the dividend yield? It's quite nice. But there are better options out there, I would say. Manny Mystery, are you seeing value in APD right now? This would be a question probably for Decliner Capitalist.
Yeah, but still. So first of all, the forward price to earnings is 24.5. That's high. Yeah, let's be straight there. But 2.5% dividend yield. So if the price drops for the stock 10%, that is meeting my entry criteria of 2.75%, but also a 5-year dividend CAGR of more than 10%, which gives it the Chowder rule of above 12 at the moment. And that makes it, of course, interesting. So let's say like that menu, if it drops another 10% and it comes to my yield zone, I will consider it because it's a Chowder stock for me. That's how I look at it.
Yeah, and we talk about quality, and this is a quality company as well.
Yeah, exactly.
Andres has asked us our thoughts on Accenture PLC, ticker symbol ACN. It seems to be a good play into the AI space. These are an Irish-based consultancy company. They do a lot of consultancy in around software and improving businesses. I did a small video on companies that are involved in the AI space. These are big players in that space at the moment. I think it's a good company. I haven't delved into the financials at a deep level, but from memory, they offered a decent yield, 2.5% maybe, and they've had decent growth, particularly for an Irish company. They are definitely one I would consider looking into, I would say.
But tell me, what is the AI play here then? Because I mainly know their consultancy branch.
Yeah, so they're really going into your company, trying to improve your business. AI is able to go in and analyze the company based on other companies and give you outputs how to improve. So they're really using it to help you improve your business. If they can do that more efficiently, if they can do that more cost effective using AI, I think that's where it comes in.
Yeah, but honestly, with ChatGPT, you might not need so many consultants anymore because of AI. So isn't that at the same time also a threat to the business? I can now give to ChatGPT, I can give a few problem statements that I have, and it generates a whole advice for me, which would take Accenture consultants probably 4 weeks to compile for me. So
possibly, but I would say consultancies will have a framework in place and probably more efficient way of doing that. Yes, anyone can go on. You can go on to ChatGPT now and get whatever information you want, but it's the framework, how you implement that. AI can only give you so much. You need people on the ground to be able to implement and show you how to do that as well.
Yeah, well, I get the creeps when I hear Accenture and AI. It's the same like IBM and AI. I think for consulting firms, it's probably something they spin here as a theme and hope to boost their sales and such. But I've seen this too often over the last years when the topic AI pops up and it's in the middle of a hype. So I want to see hard cash here to see this, because I don't buy most of this stuff. When you talk about AI, I really think about Microsoft, what they have with OpenAI in there, how they are integrating that into their software products, which are really high margin. And when it comes to consulting, it might boost their business a little bit, as like social media did in 2005, 2008 to such kind of consultancy firm, because suddenly they could influence the whole world and all their companies about, you need to have social media presence. Well, we know what it does. We just spoke about many mysteries question there. So look, I don't know enough about it, but show me the hard facts here. Show me the hard cash numbers that AI is generating for them, and then I'll reconsider looking into them.
Yeah, that's fair. As a side note, I would find it hard investing into consultancy firms like these or McKinsey.
But that's where Accenture actually shined over the last 10 years, because for me, it's really one of the best consultancy firms in the world. I would buy Accenture hand over fist compared to IBM when we talk about consultancy, as an example.
Yeah, it'll be interesting to see. As I said, I didn't look into them on a deep level, but if you look on their investor and presentation, just count the amount of times they mention AI, it's probably going to be three digits.
Yeah, and probably next quarter they will be talking about being laser focused.
And then the dividend is gone.
Yeah, yeah, no. So I don't. This kind of stuff we shouldn't take too serious at times. I think it's good that you're looking at a catalyst for businesses also like Accenture, but we should neither forget where their bread and butter is, and that's where they need to perform as well.
Good take on it. Shindu has asked us, what do you think of any of the following? So Tyson Foods, AFC Gamma, Camping World, or Whirlpool?
I honestly don't have too much opinion about these. I did do a quick check on Tyson Foods the other day. I said, I think generally sentiment is in there that although it has a great dividend history, is that the company is struggling at the moment. So the question is the risk reward really right now? I find that hard to judge for Tyson Foods. And Whirlpool, I of course know from product point of view, also an iconic company, but I honestly don't know where it's trading right now. So I find it hard to give anything meaningful of an opinion about these four.
Tyson Foods must be in the news quite a bit because we've got two questions on them. I'm not too sure. I'm not too sure about the company, as you said. If they were in the news, there was something probably happening.
Well, the price dropped, if I remember, really rapidly, and I believe also earnings. So that's why.
Okay, cool. Davide has asked us, what are our thoughts about 3M? Presumably, this is because they have dropped under the $100 mark.
Yeah, my opinion didn't change. As long as the sword of Damocles is hanging over this company with litigation, I find it hard to invest in it. I'm holding my shares are of course in the minus, collecting the dividends, but I'm not adding. Of course, I'm often thinking like, shouldn't I just add a few that I can later say when they recover, like, oh, I made use of the opportunity. But still, this company could also go the other way with the litigation. So that's why I'm staying on the sidelines.
Okay. We have a question from Alec. Do you have any thoughts on Mitsubishi Corp? So Mitsubishi, I know them really from, I know they don't do it anymore, but I remember them as an old car company. We had Mitsubishis driving around here in Ireland. I do know they're involved in oil and gas now. But honestly, I haven't looked at them from an in-depth perspective. They're a Japanese company, and normally I stick to Europe and US companies as well. Probably worth looking into maybe, but said I don't have a great in-depth knowledge of a Japanese company. Some other Japanese companies include Keyence, which I probably like to own. But no, not from a dividend perspective have I ever thought of Mitsubishi. Daniel Lugar has asked us our thoughts on two dividend Dutch stocks. I'll let you pronounce the first name because it's probably going to have a Dutch twang.
Wereldhave and SBM Offshore.
There we go.
Okay, so let's say like that. I think these are, and I believe Wereldhave as well. These are companies that have cyclical, struggling, COVID, not easy. Therefore, if I remember correctly, also not a straight dividend profile when it comes to dividend growth. SBM Offshore is, of course, really, really important with their business when it comes to upstream in the oil and gas industry. If I remember correctly, I really, really liked, but this was like 2-3 years ago when I was looking into their floating offshore solutions that they have. I just don't know where they are trading right now. So having said that, when it comes to dividend stocks, they are probably two good dividend stocks as alternatives, but I'm looking here at dividend growth. Here, both business models I struggle with to consider them seriously as a business where I can kind of feel like, yeah, over the next 10 years, they will be able to grow their dividends. So that's why I'm not further looking into these two kinds of dividend stocks.
Cool. David Sloot has asked us our thoughts on Siemens results. He thinks they've turned the corner. They've had good increase in free cash flow.
Now let's look at the hard facts here, yeah, and that's why I actually like it. Siemens, 15% order growth, 15% revenue growth, and if you look at the EPS of 4.5 at the moment, and free cash flow of 2.3 billion, I mean, these are really, really strong numbers. So yes, they had a record, or let's say like a really high quality earnings report. And yeah, that's usually the time that you regret that you didn't buy more.
Yeah. I remember when they dipped under 110, even under 100. But I'm not surprised. I haven't looked into the results, to be honest with you, yet, but I'm not surprised. We spoke about them before coming up towards the results, and I think we were expecting them to have a pretty decent quarter. So I'm not surprised at all.
No, but this company is just a high quality industrial, and I think General Electric can really learn some lessons from them.
Yeah. Indigo de la Fuente, opinion on Johnson & Johnson spin-off. I still don't know if we get shares on that yet, but if we do,
yeah, me neither.
If we do, I'm selling. I mentioned that before, so I'm not going to pay too much attention to Canuve, I'm going to say. Canuve. I'm not going to pay too much attention to it. I just want to keep my Johnson & Johnson, and I'll get rid of it.
Exactly. I have the same.
Herman has asked us, for your 10% non-dividend stock portfolio, what do you think of PayPal? I
like PayPal generally as a business between 2010 and 2020. I was using PayPal at times at that time, but now with Revolut, I don't need PayPal anymore. It's so easy to pay everywhere. Also, PayPal is not everywhere offered. Revolut is everywhere offered. Now, then you can also think about being a merchant and using PayPal, but then I have experience with Stripe at the moment. I actually don't know where Stripe belongs to, but generally speaking, I think PayPal has had the best days behind them when it comes to their business, maybe not the stock. I understand why the question is there, because it dropped 25% in share price over the last year. And actually, it's at a I would say 5-year low trading right now. So I understand where the question comes from, but I think it reflects my opinion about that this business had the best time after them, and it was a COVID darling. It went all the way to $300 during COVID. During the COVID hype, and it's now trading at about $60. So I'm staying away from the stock. I don't see a long-term business model there in a highly, highly competitive fintech landscape.
This has asked us to review his sector, his finance sector, and just give you a breakdown of some of the companies. He's got American Finance Group, ticker AFG, at 2.745. He's got Allianz, ticker ALV, at 2.24, and N Group, T Rowe Price, and ASRLL.
Yeah, I mean, I really like it. So his entire financial exposure in this portfolio is 12.9%. And I think this is a really strong one. What I really like is that it's mainly, I said, insurers, plus then T. Rowe Price also as an kind of a broker, let's call it like that. So I really like it. It's a really nice exposure, I would say, and I think it will give him really nice yield and also sustainable yield. So it's a good composition. Yeah, I like it.
Yeah, and you look at the top company, American Financial Group, obviously an American insurer as well. But have you seen their dividend growth history? Wow, it's incredible. You're looking at 10-year 12.72%, 5-year
nice.
13%, and even 15% over the last year. So they're consistent. Yeah, it looks pretty good. I've never looked into them before. The others we've all discussed on the show. He has a small percentage in BlackRock as well. But yeah, I think it's well diversified. It's nice. He's got a mixture of European, US. I like it. I like it a lot. And we move on. We have a couple of fun questions to do here before we finish off. The first one is from Bass Orlings. Man City or Inter Milan?
Inter Milan.
I'm going to go
because I like Man United.
Yeah, I'm going to go for Man City because my hope is that Man City win the treble. Pep Guardiola then leaves. Then they'll stop winning the league.
But also Inter Milan has, I believe, two Dutch players. So also there. Although Manchester City has Nathan Ake as well. But yeah, to your point, Manchester City is really, really good at the moment, and actually Liverpool is on a winning spree, and you're making it hard for Manchester United. I really feel you breathing in our necks. So
if we pip Manchester United to fourth place, we'll just do a podcast on that.
Wow, nice.
No, we won't. But yeah, I think Man City have been the best team in Europe this year. I think they deserve to win.
Nice.
And Matt Barker has said, for your 3-year anniversary, you should do the full episode using each other's accents. That would be hilarious.
Yes, we'll do our best. Maybe we can do the intro like that. But true, we need to do a 3-year anniversary podcast. We need to start planning for it, and I hope we can do it again as a live show. That would be awesome. And then I hope that everyone takes a vodka shot, not just us.
It's a shame. It's a shame I can't do this in life meetup that everyone's doing. Otherwise, that would be the perfect place to do it. But I'm on a family holiday. But we'll think of something.
Nice. Well, hey, it's the end of the show. I think it was a bit of a longer one, but I really like to do this business breakdown. And thank you. I really enjoyed it.
Yeah, we had a lot. It was 1 hour 20 minutes by my calculations. It's been good. We have a lot to talk about. A lot of good questions. I kind of wish we could spend a lot more time on the questions as well. But I think it was a good exercise to do with Realty Income. But if our listeners do like these types, please let us know. Please also let us know which types of companies to do, and we will do our best to get to them. And as always, thanks for listening. Thanks to you, European EDGI, for holding my hand through this one. I haven't been the best throughout it, but I look forward to next week's show. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.